Why inflation will be the new crisis? While inflation seems like a thing of the past just before the pandemic, bell-bottom pants and leaded gasoline were still commonplace. Inflation in 2022 is expected to continue to exceed central bank targets. It was expected to slow down from 2021 and eventually vanish as a macroeconomic issue. Due to lower energy consumption, more fuel output, and potentially even a slowing Chinese economy, energy prices should stabilize and begin to decline in the spring. However, once the world economy recovered from the devastating recession triggered by COVID-19, the same problem resurfaced. In both the United States and the United Kingdom, inflation has risen above 5% and 3% respectively, while it has soared even higher in several emerging nations. Hello and welcome to Economic Stories. Before we continue, kindly subscribe to our channel and hit the notification bell to get more videos like this from us. Now talk about why inflation will be the new crisis. Some experts have predicted that inflation will return to the levels of the 1970s when the economy was plagued by excessive inflation. But central bankers will have to lay such anxieties to rest in 2022, but not before they get a little nervous. Workers' bargaining strength has been weakened as a result of globalization, which has resulted in lower wage increases. Because people in wealthy countries were living longer, they were able to save more, resulting in lower consumption as a result of rising incomes. Some central banks, such as the Federal Reserve in the United States, were encouraged by the persistent undershooting of their inflation targets as a direct result of the global financial crisis. This led to an unexpected reversal in the policy outlook for previously reflexively hawkish institutions such as the Federal Reserve. After that, COVID-19 pounced. Several banks pumped enormous sums of money into the financial sector to stabilize the market. For the first time since World War II, governments borrowed at a level not seen since then to help individuals who couldn't work. In both 2020 and 2021, the American government's budget deficit exceeded 12% of GDP. Demand was kept from falling as a result of the stimulus, but supply was completely another story. Products and services of several kinds were halted because of COVID-19. Crops like coffee, wheat were all affected by droughts and heat waves, resulting in poor yield. And global transportation issues exacerbated the matter, resulting in record-breaking freight backlogs. As winter drew near, the rising cost of coal, gas, and oil brought back memories of energy shocks of the 1970s. There are early signals of new periods of high inflation in the United States. Struggles by companies to fill job vacancies may be a sign that the age of weak labor power is drawing to a conclusion. As a result, central banks may be overconfident when it comes to the threat of inflation because of their increased focus or reducing employment. Also known as self-inflation, inflation is a vicious cycle. Firms may find that raising prices is no longer as terrible for a company as it used to be when customers become more accustomed to price hikes. As analysts put it, inflation expectations could be de-anchored. As a result of rising energy prices, economic growth and output may be hampered. Structural reasons that dragged inflation down before the pandemic are still in place, and this is the most crucial element. As populations continue to age, global supply systems continue to be strained. There are a few signs of a broad reversal in globalization. Central bankers haven't either forgotten how to keep inflation in check. Indeed, interest rates are expected to climb around the world in 2022. It's back, but it's not going to last long. To what end? Simply put, they are inflating their numbers. The truth is a little more complicated. They inflated in 2001 and it was a success for gold, silver, commodities, and eventually stocks, roughly in that order. It worked in 2008 to 2009 as well, for gold, silver, commodities, and eventually stocks, again roughly in that order. The more sophisticated answer is that we've fallen into a debt black hole that appears to have no end in sight. An additional $1 trillion on top of the already exorbitant sums is nothing. They will inflate and they will be called upon to inflate as long as we have faith in our monetary and fiscal authorities. And COVID-19 or no COVID-19, stock mini crash or not, trust to my sight intact, speaking of my country at least. While confidence may be waning elsewhere, the average American still has faith in the Federal Reserve even though they have no idea what it does. The ordinary American also anticipates government bailout checks to be forthcoming. Anxiety like the recent spate is a distinct emotion from a lack of faith. You claim that deflation will eliminate demand, don't you? Deflation will lead to currency hoardings, right? That's how it feels right now. Every one of us is huddled together in our houses, asking the great issue of the day. Why do people prefer toilet paper over everyday household items? During a crisis, we had nothing to occupy our time. There will be no tumultuous race for the White House. Tomorrow is going to be the same. It's been made clear that the policies that have been decreed and implemented supported by the American people will have a long-term impact on the social, political, and economic landscapes. Just like in the post-2001 and post-2009 periods, the policies are geared to cheapen money, discourage savings, hoarding of cash, and ultimately boost asset values. In real time, workers are being thrown out onto the streets and numerous businesses are affected. So this will not be noticed for what it is. When it comes to non-toilet paper businesses, many are faltering. If not ceasing operations altogether, our brain factors in what we all see as deflation and falling prices as a result of falling demand in real time. The heroic Federal Reserve and politicians on both sides of the political spectrum have jumped into the enormous hole with exponential emergency measures, including, of course, some pork for their pet interests. Inflation is taking place today, although it won't be noticeable until a later date. My prediction is that if we see the first signs of inflation frenzy before the year 2020 has even come to a close, we'll see the full impact of it around 2021 or 2022. No one could have predicted what would happen to the herds of market watchers and financial specialists. Even if long-term treasury yields, the Fed was not going to go up in smoke in an inflationary conflagration. During that time, the stock market needed to decline as a result of its role as a primary beneficiary of huge inflation that began at the time. Since then, the trade war and coronavirus have pushed the yield to even more catastrophic deflationary extremes, further dampening the yield. Yields of 30 years consumer prices have been rising steadily since gold was removed from the official macro picture in the early 1970s, which has led to a continuum that spans decades. Credit has been created at the drop of a hat because of lower interest rates. As a result, a big credit operation is currently underway in response to today's major warning indication. Prices will inevitably rise as a result of money being generated out of thin air. As the herd thunders in that direction, we should be ready to capitalize, but the macro is more likely to go in the opposite direction. A slingshot for gold, silver, commodities, and stocks. 2001 was an explosive year. A slingshot for gold, silver, commodities, and stocks. 2008 was a whirlwind of activity. When Operation Twist and the instruction to sanitize inflation signals were implemented in 2011, it marked the beginning of a shift from inflation to worldwide deflation. Global deflation and US Goldilocks were the results of the Op-Twist operation. The next inflation might spread to precious metals, commodities, global stock markets, and certain US industries. We are now focusing on surviving the deflation panic and being patiently prepared for the upcoming inflation. And that's it for today, guys. Don't forget to like this video, subscribe to our channel, and smash that notification bell so you don't miss any great content like this from us. Thanks for watching, and until next time.